All right, let's jump right into this explainer. We're breaking down the Q1 2026 earnings for Live Oak Bank shares. If you've been following regional and digital banking closely, you know this is a space currently defined by shifting interest rates, loan quality concerns, and some pretty intense deposit battles. Today, we're going to unpack exactly how Live Oak navigated those turbulent waters in their first quarter, pulling the data straight from their earnings release.
So, what happens when a bank absolutely beats on profit but misses on revenue? Well, that's the exact tension we saw in Live Oak's latest quarterly report, and frankly, it left a lot of investors scratching their heads. It's a classic mixed signal scenario. On one hand, you've got phenomenal efficiency, but on the other, top-line growth didn't quite meet the street's sky-high expectations. Let's look at the hard numbers driving this.
First up, the bottom line. They brought in a highly respectable $27.9 million in net income. That translates to 60 cents per diluted common share. For a bank operating in a really tough macroeconomic environment right now, delivering that kind of solid profitability is absolutely no small feat. It proves their core lending engine is still humming along.
But then, flip the coin. Total revenue came in at $145.5 million. While that is undeniably a massive amount of money, it actually missed Wall Street's expectations. It also represented a sequential drop of nearly 16% from the fourth quarter. This immediate contrast, a strong bottom-line beat fighting against a top-line revenue miss, is the core mystery we're going to solve today.
Section 1. Q1 2026 Headline Results.
Now, take a look at the trend here. Core earnings per share reached 60 cents, which actually blew past analyst consensus estimates by over 10%. When you map the trajectory from Q1 of last year all the way to Q1 2026, you're seeing a bank that consistently finds ways to generate sustainable earnings, even when the broader revenue picture fluctuates.
So, we have this massive contrast playing out right in front of us. Look at the left side. Incredible loan origination, over $1.37 billion in just one quarter, alongside year-over-year deposit growth of 11.6%. They are bringing in money and lending it out like clockwork. But fighting against that is the sequentially lower top-line revenue and lower pre-provision net revenue, which is basically the income the bank makes before they set aside money for potential bad loans.
Now, a really vital metric for understanding a bank's health is the efficiency ratio. It essentially tells you how much it costs them to generate a dollar of revenue. Lower is always better. Analysts were expecting an efficiency ratio of 61.4%. Live Oak absolutely crushed that by posting a lean 58.6%. This is a huge deal because it proves that despite the revenue miss, management is keeping a very tight lid on overhead expenses.
And CEO Chip Mahan remains highly optimistic about all this. He stated, "We are pleased with the momentum we've carried into 2026. Our first quarter results reflect the strength of our differentiated model and our commitment to serving America's small business owners. They truly believe their specific, technology-driven approach to SBA and commercial lending, a model they built back in 2008, is working exactly as intended."
Section 2. The balance sheet breakdown.
When we pull back the curtain and look at the raw ledger, a super clear story emerges. Yes, net income dropped sequentially from Q4 down to $27.9 million. But zoom out for a second and look at the year-over-year explosion. A year ago, net income was just $9.7 million. That's a staggering jump. Add in a steady climb in total assets to $15.3 billion and deposits pushing up to $13.8 billion, and you can see the long-term growth engine is undeniably intact.
Which brings us right back to that glaring revenue question. That sequential revenue drop of nearly 16% from Q4 to Q1. It looks terrifying on the surface. When a stock misses on revenue, algorithms and quick-trigger investors often just sell first and ask questions later. But we really need to understand exactly why that massive spike in Q4 happened in the first place.
Well, it turns out the Q4 anomaly was driven by massive one-time gains. Live Oak had pre-tax gains from the sale of Aperture and another portfolio investment, which totally artificially inflated those Q4 revenue numbers. When you strip away those one-time events, the Q1 2026 revenue of $145.5 million is actually a very solid 18.4% core gain year over year. So the core business is growing beautifully. It literally just looks like a miss because of a distorted comparison quarter.
Section 3. Credit health and provisions. Now, what about the risks? Live Oak set aside $20.1 million as a provision for credit losses this quarter. Think of this as the bank's rainy day fund. It's money they park to the side in anticipation of loans that might go sour down the road.
And while net charge-offs, meaning debt they've actually deemed uncollectible, were over $18 million for the quarter, the overall credit performance is remarkably stable. The allowance for credit losses relative to their total loans actually ticked down slightly to 1.62%. Non-performing loans are sitting at around $444 million, which is well within expected parameters for a loan book of this massive scale. What this actually means is that their underwriting is rock solid. Despite managing a $12.5 billion total loan portfolio, their provision expense actually decreased by $1.7 million compared to last quarter, and it's down almost $9 million year over year. So their credit deterioration is entirely manageable and actually improving against past quarters. That's a fantastic signal for the health of the small businesses they lend to.
Section 4. Mixed market reactions.
So, with fundamentally strong growth, stable credit, and a totally valid explanation for that revenue mess, how did Wall Street react? You'd think they'd be thrilled, right? Well, data analysts noted a distinct pattern. Investors do not consistently reward Live Oak's results. Historically, earnings releases here trigger mild sell-offs despite objectively solid fundamentals, with the average price move being a negative 1.12%. Wall Street just remains selectively skeptical.
Moving forward, institutional observers are laser-focused on a few future trends. First, they're watching the trajectory of loan growth and business checking. They're also keeping a close eye on shifts in credit costs and the net interest margin, which currently sits at a healthy 3.27%. Finally, everyone is watching to see how they might utilize their new S3 ASR shelf registration, which gives them the flexibility to quickly raise capital if they spot strategic growth opportunities. As a pioneer in digital small business lending, Live Oak continues to prove its model works on Main Street, even if Wall Street's day traders can't quite make up their minds. They are consistently growing assets, growing deposits, and managing their risk incredibly well.
It leaves us with a final, really vital question. In an unpredictable 2026 economy, how will the market ultimately reward fundamentally sound but volatile banks? When will they stop punishing headline revenue volatility and look at the core growth? Keep a close eye on Live Oak, because their next quarter might just hold the answer. Thanks so much for joining me on this explainer, and keep learning.